Hello, everybody. I'm Mike Hengehold, and Doug Johnson, the director of HCM's investment group, is on the line with us as well. Since we're having a fireside chat today, I think I'm going to put another log on the fire here at the HCM Mountain Lodge. I hope everybody is doing well managing the quarantine and staying healthy. I don't know how many of you had a chance to see the short video that we sent out earlier today, but I just want to reiterate that we have a desire to help anybody who needs help during these times. So if you know somebody that's a little stressed out with everything that's going on, if it's in the financial realm, go ahead and get us connected. No strings attached. We are happy to help any way that we can. If you saw today's call reminder, you saw that there is an agenda for today's call. There is a link in that to the info at HCM, which is how you would submit questions if you would like to do that, if you haven't done so already. And we're going to be limiting this call to 30 minutes. So if we have any unanswered questions at that point, your advisor will get back to you, or either Doug or I will call or send you a note to give more details about the answers for that. One update item that I wanted to offer before we get into the market-related material involves some clarifications that came out this week regarding tax filing. So originally, the Treasury and the IRS came out and announced that tax payments that were due on April 15th would be suspended until July 15th. This past week, they've come out and aligned the filing requirements with that same date. So now, as far as your federal tax return goes, both the tax return and the payment that would have been due on April 15th is going to be due on July 15th. There's been some misunderstanding about that, though. That doesn't sweep away all your payment obligations. That would cover the taxes that are due from 2019, so if you would have had a balance due from last year, and your first quarterly estimate, because that's the only part that was due on April 15th. A lot of people seem to believe that the second quarterly estimate is covered, and the service has not announced anything with regard to that. So you would still have a payment due in June for a second quarterly estimate if, in fact, you make those payments. The other issue that we're still a little bit at sea on has to do with state and local returns. We have clients in some 33 or 34 states, so I'm not going to go into all that, but obviously we're located in Cincinnati, and so we're right in the hub of the tri-state area where we deal with Ohio, Kentucky, and Indiana. It's my understanding that 43 or 44 states are required to follow the federal government's, or they're connected with the federal government in terms of establishing their filing and payment dates. And Ohio is one of them, but Ohio has yet to come out and tell us that they are going to follow the federal government in extending these payment dates and the filing dates. Both Kentucky and Indiana have indicated that they will. This is a big hurdle for state and local governments because, unlike the feds, they don't have printing presses to solve their problems, and so this becomes a real budget issue for them if their tax collections get postponed. But it's something that is, we fully expect Ohio to come along. Based on my review of the statute, they really don't have any choice. I called the state today, could not get an answer from them, so we will let you know as soon as that gets resolved. So that was the one thing I wanted to add that was not in the agenda because we hope to see some resolution. So now with no further ado, on with the main act. Doug is going to discuss the recent tsunami of stimulus that's coming our way, give you some perspective on the latest market activity and whether yesterday's rally marks the bottom. And today, the market's continued nice rally mode today. And finally, we'll talk about what still worries us and where we think the bright spots are. So, Doug, you're on.
Great, thanks. Can you hear me, Mike?
Yes, I can. We're in good shape.
Okay, great. So good afternoon, everyone. In the interest of time here, I want to try to touch on these three items. as quickly as I can, but I also want to provide some meaningful detail. So as Mike said at the beginning of the call, if there's anything that you want more information on after we're done with this, please feel free to reach out to myself or to your advisor, and they will put me in touch with you as soon as we can do that. So the first item on the agenda is I wanted to just quickly run over some of the details of the dual stimulus that we've seen. So the first being an announcement by the Federal Reserve on Monday morning that they were expanding their quantitative easing program. Now, without getting into the intricacies of what this actually is, think of it this way. They basically came out and said there is absolutely no limit to the amount of money that they can print and use to back the credit markets, the municipal markets, and the money markets. So if you think back to 2008, I believe the first QE program was capped at $200 or $300 billion. This one has absolutely no limit. So it is being dubbed QE infinity. So this is important because it allows the credit markets to hopefully function properly and aid some of the bond dislocations that we've seen, particularly in the muni market as well. As Mike mentioned, now the issue with collecting tax at a state level has caused some trepidation. So that's the first round of stimulus that we've seen. The second one was approved this morning, and then it was unapproved, and then in typical Washington fashion, they're going to vote on it, I don't know, tomorrow at a later date. This seems like a pressing issue, but they don't really seem to have much urgency to get it done. But here are the outlines of some of the things that are being discussed. So in terms of what big business would get, so about $500 billion used to back loans and assistance to companies, including $50 billion for loans to U.S. airlines as well as state and local governments. On the small business front, you have about $350 billion to aid small businesses, including $10 billion for SBA grants and up to $10,000 for small business costs, $17 billion for loans, et cetera. For hospitals, you have $150 billion used in the healthcare for equipment and supplies. And then on an individual basis, the proposal was for direct payments to lower and middle income Americans of $1,200 for each adult, as well as $500 for each child. I believe that income threshold is $75,000 a year, but again, that could change by the time that they vote for the final bill. Now, one of the features of this that I think is important to point out is there are some restrictions on this money. So the two that I think are important and that we've touched on already, the most important one. So any company that receives a government loan would be subject to a ban on their stock buybacks through the term of the loan plus an additional year. Now, there's been further clarification on that point that as long as that loan is outstanding, the company will not be allowed to pay dividends either. So if company XYZ goes to the government and says, we need $20 billion, until that $20 billion is paid back by company XYZ plus an additional year, they will not be able to buy back their own stocks. And while the loan is outstanding, they will not be able to pay dividends. So that is kind of an important feature of this. Executive bonuses and some executive compensation will also be limited. And then there's some other kind of less important restrictions on there that I think will come out. So in terms of the totality of this, if you take the Fed's unlimited QE program plus this bill, you're looking at about $6 to $7 trillion worth of stimulus. If you compare that to U.S. GDP last year, that was around $23 trillion. It's a pretty hefty chunk of money here that we're about to throw at this problem. The question is this a financial problem? Is it a medical problem? Or is it both? I think that's still being sorted out. But moving into more market-related moves now, it seems the market has been a fan of this. The S&P 500 is up about 15% off the intraday lows on the 23rd, on Monday, at about 2,200. in about 48 hours. So it's nice to see that kind of rally because we've had so many days of big red numbers sprinkled in with a little green, but this is also the first time we've seen consecutive back-to-back up days. The issue here is it's not 10% or 9.5% days are not particularly healthy signs. If you look into comparisons of other bear markets that we've seen, the kind of three-phase approach is what we're looking at here. The first phase being that initial sharp decline, followed by some kind of counter rally. Whether or not this is the beginning of that rally is yet to be seen, but you have a lot of people that have kind of been calling for this as we've been at extremely oversold levels. And then the final washout phase, that is phase three, that may be yet to come. But you've heard Mike use the term waterfall decline, and there's really no hard definition for a waterfall decline, but it's basically a sharp, steep decline with a lot of selling and not a whole lot of buying. So there's we did some research on what to expect after waterfall declines, and I think it's pretty interesting. So we've seen about 10 of these since the Great Depression, and what you've seen in almost every case from the end of the so-called waterfall decline, and if we're going to characterize what we've just seen as a waterfall decline, which I think is fair, you've had almost every one of those, with the exception of 2018, retest the low levels at some point. So if we think about what a retest is, it's just when the market comes back down to its previous low point. So if we consider 2200, 2250 a low, we would expect at some point the market to come back down to that level and quote unquote retest those. Now, in 70% of those cases, the market went on to make new lows. So they would go retest the lows and then actually break through that point. Now, again, these are all historical comparisons, and each one is unique in its own sense, and this one could be different. But based on previous bear markets and what we've seen in the past, thinking that the bottom might have been 2 days ago, there's unfortunately not a very high probability of that. But we've also never had this level of stimulus injected into the market during these instances. So it could be a first. In addition to that, the average time that we see to the bottom of the initial decline to the end of the bear market has been about 2 months. Though, to give you some comparison to 2008, because that's floating around quite a bit now, the end of the first waterfall decline was in about October of 2008, and the market didn't bottom out till March of 2009. So just to give some perspective about kind of the initial decline and kind of what we've seen over the past 2 days. Unfortunately, while the rally has been strong, I think there's still a lot of uncertainty to be sorted out. And granted, this rally could continue for a few days to some higher levels, but we think once the economic picture becomes more clear, it's going to provide a pretty significant headwind. So that kind of dovetails perfectly into our last point here, reasons why we're still concerned and reasons why we can be optimistic. So, on the concern side, we've talked about different phases of this cycle. The first being kind of the shock around the social aspect of this. So I believe San Francisco was the first major city that had some kind of shelter in place or lockdown, or it could have been possibly in Seattle. But when those headlines first came across, it was very shocking and jarring. We'd seen it happen in China, but I think in the back of everyone's mind, there wasn't a whole lot of belief that could happen in the United States. Well, now we have several cities in shelter-in-place orders, including the state that most of us are in Ohio. But I think at this point, that shock is worn off. If they came out tomorrow and said that Chicago's shelter-in-place, it's not that nobody would care. It just wouldn't be that big of a surprise at this point. So we've moved past that initial shock. Now we're in the middle of what I like to call the government and Fed saves the world phase, where you get this injection of massive stimulus and programs that are designed in order to kind of prop up the market and try to help everyday people who are getting laid off continue to pay their bills. So we're right at the tail end of that, and usually that's where you see a little bit of optimism pop up. You see a little bit of bounce back in the market, and that's what we've seen. Unfortunately, the last phase is the one that I don't think we're quite at, and usually the one that can be the most or the longest phase, and can lead to some long, drawn out, grinding declines, and that's the economic phase. And as analysts and CEOs continue to try to model out what earnings might look like going forward, they still just don't have a good idea because the numbers just aren't there. Even if we were to reopen the market, or I'm sorry, if we were to reopen the country tomorrow, the demand destruction that we've seen is very real. And I think as long as the virus is active, which it still is, people would certainly change their behavior patterns to reflect that. I saw a chart today that said the TSA tracks passenger counts on airplanes, and versus what it was last year at this time, we're running at about 10% of that number. So even if we said everyone can fly wherever they want right now, my guess is that 90% gap would not be filled overnight because people would still be concerned about the virus. So I think there was a little bit of optimism surrounding the fact that we may try to open the economy a little bit sooner. But even then, it's still going to take some time to get back to full capacity. And that damage destruction is real. And until we can kind of quantify that, I think that the uncertainty around the market kind of taking off and it just being business as usual, that's going to provide a massive headwind in preventing that. So, the fiscal stimulus will help people pay bills, but it's not going to get them back to 100%. And I haven't heard anybody tell me that they were able to go back to work because the Fed increased their QE limits. So that's kind of still our main concern. And right before we hopped on this call, I think I saw a headline that said California is either expected or has already reported up to 1 million people have already filed for unemployment. So we have a national unemployment number that comes out tomorrow, which will probably be extremely ugly. So what can we be optimistic about? So whenever the Fed has been aggressive with their policies, it's usually been a positive for risk assets, though this is going to put them to the ultimate test. And I think the stimulus in a way provides a little bit of a psychological boost for investors. They get the feeling that the government is there to kind of help them, and this sense of, they'll do whatever it takes to prevent this from completely falling apart, provides a little bit of boost and maybe provides investors the impetus they need to go into the market and buy. But I still think, will it be enough is the question that still remains. But at the same time, I think, we may have reached a point in the market where we've moved past the just absolute indiscriminate selling, hand over fist that leads to, 7, 8, 9, 10% down days. But that certainly doesn't mean that that we can't still have a kind of lower trajectory market here over the next few months. But we certainly hope that's not the case. But I don't think there's enough evidence right now that would imply that we can bet against that, so to speak. So Mike, that's what I've got.
All righty. I'll let you take a breath. We've got some questions. The first one I'll do my best to take, and you may want to add something to it. This kind of spools off of what you were just talking about. Following up on yesterday's big rally and the fact that the market was strong today, can we feel comfortable that was the bottoming process? We've talked about V bottoms. That certainly looks like a V if you look at it on a chart. How should we think about that? My spin on that is that we kind of have to step back and, well, let me start over. that requires some knowledge of the future. And for everyone who's been a client for some time, you know that my crystal ball is in the shop waiting for parts. So I had to get that in somewhere. With that being said, there's a lot of uncertainty, what we like to call the known unknowns. And the known unknowns are the areas that we can focus on. Doug just mentioned unemployment. We know that's going to be bad. But on the good side, we know we have between $500 and $800 billion, that was with a B, of rebalancing dollars that need to buy stocks. So for various types of accounts, pensions, institutions, things of that nature that follow very disciplined model portfolios, we know that the rapid drop in stock prices means that the percentage of stocks in those portfolios is lower. The discipline that's followed forces them to buy equities. So we know that in the near term that this forced rebalancing has to occur, and it's going to, on top of the stimulus, it's going to be huge dollars. So that's a bullish force that certainly is part of what's going on these last couple of days. To counter that force, we also know that there is forced selling yet to come because there's still a lot of leverage left in the system, and we really don't know how much that is, but we know that it's coming. So that's why that's an unknown item. The reality is policies are not yet aligned. So you can tune in the evening news any night and watch the Democrats and Republicans argue over exactly what the right approach is. You heard Doug mention earlier this big stimulus bill was signed, then it was not signed, and the House and the Senate are going back and forth over what Christmas tree ornaments should be hung on the bill and so forth. So, and that kind of goes, the wrestling match. The administration yesterday said they would like to see everybody back and all the quarantines lifted by Easter. And when you read the commentary from the healthcare professionals, they don't seem to be talking like they think that's a realistic option. So, so that whole issue of aligning these policies is a big unknown that's yet to be sorted out. On the economic side, we're seeing terrible numbers come out of Europe. They could easily go from recession to something worse than recession, and we don't know what that would mean for economic contagion, much less just what does it sort of forecast for us as those things continue to spread out when we look at all the uncertain economic effects of that we're yet to see. Doug mentioned unemployment. We really haven't seen any of the impact here in the formal U.S. economic numbers from the virus. Those will really first be coming tomorrow with the unemployment data, and it is expected to be a doozy. But everybody expects it to be bad. So if it's just bad, that probably would not rock the markets. But if it's really, really bad, that would be the surprise effect that could move things on. So at a minimum, based on the pattern of other bear markets that Doug's already talked about, we would definitely expect to see more volatility as the market would at best go through a bottoming process and potentially retest and penetrate these levels even a little bit further. Okay, Doug, this one can be for you.
Okay.
The question is, how do we see this situation affecting dividends?
Yeah, so as I mentioned earlier, any company that's taking money from the government is not going to be allowed to pay a dividend. Now, I don't know what that is going to entail. I mean, there's been some bigger name companies in the news that have already taken the steps to suspend their dividend, Boeing being one, and Ford was the other. But my hope is that the bigger companies that are less leveraged, that are in good shape, they're going to want to continue to pay a dividend if possible. I don't know if it's going to be the same dividend. it could be a reduced form, but I think most of them, they kind of cherish that ability to say, well, we've paid a dividend every year since 1932 or 50 or pick a year. So I think companies are going to do everything that they can to continue to pay those, but I think they're also going to be mindful of what other companies are doing. So if 5 of the biggest 10 dividend payers come out and say, you know what, we're going to be safe rather than sorry, we're going to suspend our dividend for the time being to ensure that we have sufficient cash flow to get us through this. Those might be punished, but then the 6th, 7th, 8th, 9th, 10th company that does that, their decision then becomes a little bit easier. They could try to stand out from the crowd and say, hey, we want to be the one that stays. But if they go along with everybody else, I don't think that it will be as big a deal. But I think on the fringe, you're definitely going to see reductions, suspensions, possibly eliminations of dividends for lower quality companies, and you may see some other higher quality names that you wouldn't expect, just to be on the safe side. Say, hey, you know what, we need to think about our capital structure a little bit. I know that a company like Intel, who's a very strong company, pays a solid dividend, has already announced that they're suspending their share buybacks. So that's a form of return of capital that they've already looked at and said, we want to take this out. So it's still unknown, but I would expect to see some reduction in the lower quality names and maybe a little bit in the higher quality, but until we know for sure, it's hard to say.
Okay, you're on the clock with this one. You got 30 seconds. Do you have triggers to sell or buy when investments hit certain limits?
So do we have hard triggers with levels? No, not specifically. It's kind of an aggregation of several different things that we pay attention to. I liken it a lot to running medical tests on a patient. You could see them. They may look healthy on the outside, but you get your test results back. You've got high cholesterol, you have high blood pressure. So things that are kind of percolating under the scenes that we believe give a good representation of the health of the market, both in bad markets and good markets. So that's going to drive a majority of our decision making.
Perfect.
I think that was 30 seconds.
Perfect. So that we're just about at 30 minutes. That will do it for today's call. I want to thank everybody for participating in the call. I want you to know that we're listening to help improve everyone's experience on these calls. So we've done things like we've gotten more dial-in numbers to make it easier to get in. We've offered the specific agenda. We're going to hold to a more rigid timeline. And we're also starting a little bit earlier to make that more convenient around people's work schedules and dinner times. We want you to know that we're praying for everybody who's suffering in any way from this whole ordeal. Remember our offer to help if we can. If you know somebody who's in financial straits over this, let us know. If we can do something, we will. With that, I just want to say thank you for everybody at HCM Wealth Advisors and HG CPAs, and we'll talk to you next week if this turmoil continues. Thank you very much, everybody. Bye-bye.